Good afternoon, guys. Welcome to another webinar with Shreek. Thank you, Zirda, for having us. In this webinar, we are going to cover about RSI divergence. We'll first understand what divergence means and how to visualize that in chart, and then build that on Shreek and use it in Scanner. Okay, so let's get started. So, what is divergence, right? Divergence is basically formed when the prices are saying something but indicators are saying something else, right? So the new high which is being formed or the new low which is being formed, right, it is not being confirmed by the indicator. So let me quickly show you an example of this. Let me just open a chart. I'll just look at weekly highs, weekly prices. So a very simple example of divergence, if I look here, will be somewhere here. If I have to draw and quickly explain that, this is how it will look. Let me just draw a line here to explain what a divergence looks like. So the RSI that is being formed here, so I have plotted 14 RSI. The higher high, the high. So here if you look, RSI is forming lower high. What that means is the new high of RSI which is formed here for the high price, okay, that is lower than the previous RSI when the price was at its previous high. Whereas if you connect the lines, if you connect the points drawing to the connecting the highs that were touched by the price, right? So price has formed higher high. What that means is here a new high price has been reached, which is higher than the previous high. Whereas at the same point of time, RSI is showing forming a lower high. Now this is a very simple example of divergence, where price is showing something else, but the indicator is showing something else. So this is how a divergence looks like. Now what does this imply? What does it signify? We'll cover going forward. But as you can see, the price was showing an upward trend, whereas an indicator if you look at the chart at this point of time on this date, right, or in this week, because it's a weekly chart, you would easily see that okay, now there is a divergence that has occurred with RSI and price. Now what does it imply? Does it imply the price falling? And price actually falls continuously for 3 weeks post that. So we'll look more deeper into it and understand different kinds of divergence and things like that. But I just wanted to give you a very simple example of how a divergence looks in a chart. So to simplify, when the price is saying something, the price is forming new highs or new lows, whereas indicators are forming new highs or new lows in the opposite direction. So here the price has formed higher high, whereas the indicator has formed a lower high. Great. So divergence can be used to gauge the strength of the trend, okay, by measuring the momentum with respect to price. So here the price went up, but indicator didn't show that the momentum was there, so the trend looked like it might reverse. So divergence is a leading indicator, unlike other indicators like moving averages, Bollinger Bands, and super trends. Divergence is considered more to be a leading indicator because it sort of identifies the divergence or the directional change between what the prices are indicating versus what the underlying indicators are indicating. Now a divergence can be created or can be checked with various kind of indicators: RSI, MACD, OBV, ROC, CCI. But in this example, we are just showcasing RSI. You can use similar concepts of divergence on other indicators as well. So let's look at what are different types of divergences. So there are two kinds of divergence. First is regular divergence and second is hidden divergence. Now what is the difference between them? Next slide covers that. right? If you guys have any questions while I'm explaining this, please type it into the chat, and we will be happy to answer to you, right? Now again, both kind of divergence has a bullish and bearish divergence. Bullish divergence basically indicates the trend is going to be bullish, and bearish indicates that the new trend is going to be bearish. Quite straightforward. Okay, so how do this? So we covered that there are two kinds of divergence. One is regular and one is hidden. Now, what is the difference between them? Okay, so I have underlined the point here, which is very simple. In regular divergence, the indicator indicates the probable future of the move in price. So remember this here. This is a regular divergence, and here indicator is showcasing a downward trend because it formed a lower high, indicating that a bearish trend might start. So we'll cover that in detail, but keep this in mind. A regular divergence, indicator indicates the future of the price, right? Whereas in hidden divergence, price indicates the probable future move of the price itself. Okay, is this clear? Great. Let's move on. Okay, so now till now we have understood what a divergence is. There are two kinds of divergences, regular divergence and hidden divergence. Now let's understand bullish and bearish regular divergences, which are shown in the graph before. So okay, a bullish divergence, okay, there the price is forming lower low. So we have put a snapshot here for you to look at it, what it means. So the low of the price currently is lower than the previous low that it has established. Now, how do we identify what was the previous low? We'll cover that in the formula going ahead. Okay, so a lower low is formed by price, whereas an indicator is forming a higher low. What that means is the lowest value of indicator currently for the low price is higher than what it was for the previous low. Let me repeat that slowly again. When the price is forming lower low, what that means is the low which is formed now is lower than the lowest low it formed before. Okay, so if you look at the graph here, the low is shown where my cursor is. That's the new low. Before that, the low was formed somewhere here. Now that the new low is lower than the previous low, that's why it's called lower low. Okay, so price is forming lower low. Now whereas indicator is forming higher low. How higher low? The point at which the price is at its lowest here, the indicator's low value is still higher than the earlier point where the price was low. So the low value of indicator is still higher than the low it had formed before when the price was at its lowest. In this time span we are analyzing. Okay, so keep this in mind. With examples, once we run in scanner, we will easily be able to identify that. So with this, what did we do? We basically identified a bullish divergence. Price and momentum should move in line with each other, okay, which basically means at the same time the indicator is showing something else and price is showing something else. So what does this imply? The new low in the price is not supported by the low indicators. What that means is the price might have reached a new low, but your indicator is forming a higher low than what it had shown before, indicating that a bounce back or a trend change will come. So after this candle, if you see, there are 3 green candles which have formed, indicating, I mean, in this case the divergence actually worked out and the price became bullish, even though it was a bearish trend before that, before the divergence had occurred. Okay, let's look at what a bearish regular divergence looks like. So I know it is a bit technical here, that's why I'm covering the theory very fast, because these things you can just keep in mind, and after some tries you will start seeing this forms and this patterns form in chart very easily. So you can easily use scanner to first identify those stocks where a bullish or a bearish divergence is happening, then look at charts and then decide to take trades based on that or not. Okay, great. So again, bearish divergence, price is forming a higher high. What that means is the new high which has formed is higher than the previous high, whereas that means price is going up, right? Whereas the indicator is forming a lower high. The new high of the indicator is lower than the previous high. Okay, so you see the lines are going in opposite direction. So the price line is inclined upwards, whereas the indicator line is inclined downwards. This is not a very strong divergence, but for example purpose we have just showcased here. So after this a bearish trend starts, the price doesn't go up any further. So this basically implies, the implication of a bearish regular divergence is basically whatever the indicator said, right? Indicator said that okay, the trend is not that strong, so the bearish trend will start. So the momentum during the second high in the price is lower than the momentum during the previous high, warning the trend might reverse. That's what. So the trend didn't continue, it slightly reversed, it didn't reverse drastically, but again this is just an example for us to understand how a regular divergence looks like. Coming to the next part, hidden divergence. Okay, hidden divergence are slightly different. In this case, for a bullish hidden divergence, the price has to form a higher low. That means the new low of the price is higher than the previous low of the price. Now again, you don't have to remember all of this. You can just print this out or take screenshots of this and use it as reference. But once we build scanners, then you don't have to actually remember any of this. You can just understand what happens when those kind of things happen based on the name of the scanners you have given, right? But just so that for people who want to understand, for people those who want to sort of analyze much deeper, I'm just explaining this. So in hidden divergence, a bullish hidden divergence, higher low is formed, whereas the indicator is forming lower low. So the new low of the indicator is lower than the previous low of the indicator, right? So that's lower low. Price higher low means the new low is higher than the previous low. Okay, so this basically shows, remember, in hidden divergence, price showcases the going trend, not the indicator. So the divergence generally signals continuation, hence bullish trend might continue. Okay, so because this is a bullish divergence which has formed, bullish price trend might continue going forward, whereas a bearish hidden divergence looks something like this, where the price has formed lower high. What that means is the new high is lower than the previous high, okay, and the indicator has formed higher high, okay, which basically means the new high of the indicator is higher than the previous high. This basically indicates that the signal that the bearish trend might continue. So bearish hidden divergence signals a continuation of bearish trend, okay, in this scenario. So having said all of this, keep in mind divergence basically showcases that the direction that is being indicated by the indicator and the direction which is indicated by the price are in different directions. Okay, now let's look at the logic of how to create divergence. And it's not just on streak, but anywhere where you are analyzing divergence, this same concept applies. To identify divergence, first you have to split the chart into, when I say split, you have to consider the chart in two periods. Why do I say that? So if I have to look at, let's say, for any indicator which you plot, let's say you plot moving average, let's say you plot SMA or any of those kind of things, you primarily focus on how many period moving SMA you want, how many period RSI you want. Same way, if you are looking for divergence that has happened in past 10 days or past 20 days or past 10 weeks, very simple way to look at it is you have to identify 2 points. Okay, so first point is if I divide this, let me just draw a line so I can explain this. So I drew a vertical line. Okay. So in this period, before this line here, wherever I am moving my cursor, we have identified that this is the high. Now after this cursor, we have identified that this is the new high, which is, let's say, currently. Now in these two period, you can, so this let's say is some 10 weeks, and this, let's say, is 10 weeks. In this period, if you connect the highs which are being formed, a higher high is being formed, whereas in this scenario a lower high is formed, which indicates this, which indicates a bearish divergence. Okay, and after this, anyways, after this point when the divergence was identified, the price anyways has moved down. But irrespective of that, the way to identify divergences, first you have to specify the period. So here we have showcased 10 days, 10 days. So the first 10 days we identify what is the low. So you can basically say the lowest point of the past 10 days. Now the next 10 days we look at what is the new low that is formed in the next 10 days and connect those points. So in the previous 10 days, this was the low which was formed, where the cursor is. In the new 10 day or the current latest 10 day, this is the lowest point which has formed. So if you connect these 2 points in the chart, like how I showed for a weekly chart on the Kite website, you basically get a line. Now if you do the exact same thing, connect those points with for the indicator as well, you get another line. Now if those lines are not showcasing the same trend, that's a divergence. Now what kind of divergence it is, it can be classified very simply in this either of these 4 formats. Okay, so let's go ahead and create this so that you can see how it actually looks. So first we will create regular bullish divergence. So it basically indicates this, the first one, it basically indicates that a bullish trend is going to start. So let me quickly go to streak and click on new scan. So to create a scanner, you just have to go to scanner and click on new scan. I'll scan on Nifty 100 on 1 day time frame. I'll use candlestick charts to identify divergence, and then I'll start building it. So first thing, if you see, it says period min of 10 days low -1 is lower than period min of 10 days low of -11. So why is this like this? Let me quickly create this and explain that. So period min lets you get the lowest price, okay, or the lowest value till now. Okay, now once I do this, I'll show it in chart how it looks like. So remember, we are creating bullish divergence, which is basically identifying a lower low being formed. So that's why we first took that the latest low, which is this low, is lower than the previous 10 candles low, so which is this low. Okay, whatever was identified there. Now this period, 10 here and 10 here, you can choose as any period. So what the first line does is it identifies the lowest low that was formed in last 10 candles. Now this identifies the lowest low that was formed in last 10 candles after 10 candles. So that means the lowest low that was formed in last 10 candles going back. Okay. So now this is basically forming the first upper line. So you are basically finding those stocks or scripts where the first the price condition or the price line is being formed. Now let's click on add another condition. Now we will create the indicator forming a higher low. Okay, so again we use period min because we want higher low. Okay, instead of low price we can just say RSI, and I will just say -1. So this basically lets me identify minimum value of last 10 candles for RSI, and I clicked on plus, and then I say higher than period min. Okay, so this basically is letting me create a higher low. Okay, offset you have to remember, here I have given -11. Now if let's say you want to create this on a bigger period, so at that point of time simply all you have to do is so see here, let me first explain what is written here. So here we are checking if the low is made by 10 candles, which is lower than the low made by 10 candles prior to the latest candle. Okay, which basically forms the price line. Then RSI of the newest low that is formed by RSI in the last 10 candles is higher than the low made by RSI in prior to the latest 10 candles. Okay, for simplicity purpose, if I have to quickly make it look like, if I have to show it in chart, this is what first condition forms, this is what the second condition forms, both in a period of 10 days because we have put offset as 10 days. Okay, now let's give it a name. Let's say regular bullish divergence demo, and let's run scan. So as you can see, the results have come. So you can see how fast the scanner runs, and it quickly identifies the stocks which have matched the criteria. So let's look at a stock where the regular bullish divergence has occurred. So let me quickly open HDFC in chart, and we will quickly analyze why is it identifying that. So let me just open this. So we are looking at day candle. So let me plot that and let's analyze this. So in past 10 days, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Right. So it is basically showcasing this. The previous 10 days low and the new 10 days low is in this direction. Sorry. Okay. Whereas the indicator RSI is showing an indication in this direction. Okay, so this clearly shows that a bullish divergence is happening. If you remember this, a bullish divergence looks like price is showcasing a downtrend, whereas the indicator is showcasing an uptrend. Okay, so indicator is forming higher high, where indicator is forming higher low, and price is forming lower low. Okay, so how do we say that it is forming lower low? So if you look at in past 10 candles at this point of time, what was the low versus what is the low now, right? So it will be something like this. Okay, let's quickly look at another stock which was identified. Just a second. So let's say TCS. So let me just quickly plot TCS. So TCS basically in last 10 days, if you connect the lower lows, it's like this. Whereas if you connect the one second, let me just move this line up, rotate it slightly. If you connect the lower lows of indicators, it is forming a higher low. So this TCS shows a clear divergence showcasing a bullish trend starting, because the new low which is formed is lower than the previous low, whereas the indicators are showcasing a bullish trend. So this is how you can use streak scanner to quickly identify bullish divergence or any kind of divergence that is being formed. So if you run this on Nifty 500, you get a lot more stocks, and you can easily check and validate that and decide to take trades based on your call. So this is the first one which we have created. Let's quickly look at the other ones, other ones which we had covered. So how to create a bearish divergence? Here you basically are trying to identify the higher high being formed by the price, whereas the indicator is forming a lower high. Okay, so I already have gotten it created here for time saving purposes. Let's click on this. Let me run scan. So we can quickly see that a bearish divergence is formed by a lot more stocks. Let's quickly let me just quickly open other ones which we have open. So these are regular divergences. Let's look at how hidden divergence looks in chart. So hidden divergence, the concept is again very simple. You use period min to identify any higher low which is being formed, and then you use the similar concept, another condition, to identify lower low formed by the indicator. So we'll first look at hidden bullish divergence. So let me quickly open that now. So we see that hidden bullish divergence is being formed in these stocks. How many of them are clearly looking versus how many of them are not clearly looking? Let's just look at that as well. So let's open Concor. Okay, so here again, if I have to draw the lines as to explain how this looks, the lower low is forming is being formed like this. Okay, let me just quickly yes, the past 10 days. Whereas if you look at the indicator's lower low is formed like this, is forming on the lower side. So we can clearly see a divergence which is being bullish hidden divergence which is being formed, because price has formed higher low, whereas the indicator has formed lower low. So price has formed a higher low, whereas the indicator has formed a lower low, indicating that the price is going to continue, is likely to continue in upward direction. So that's an example of a bullish hidden divergence, because remember, in hidden divergence the price indicates the likely direction. Okay, now let's look at the last one, which is hidden bearish divergence. Let me just quickly scan that. So this is how you can identify these stocks as well, right? So moving forward, key things to keep in mind: when divergence works best when the indicator is in overbought or oversold region. So if you remember, we looked at a chart for, let me just try to recollect, I think for some stock I had seen where when the indicator, let's say the divergence is being formed when RSI is above 30. In both the scenarios, the higher high or the lower high which is formed is in above 70, sorry, and at that point of time, if it is indicating a bearish trend, then it works much better than actually when it is in non-overbought or oversold region. So this is something which you can keep in mind when you are identifying divergence. And double divergence has higher success than single rate divergence. Now what does double divergence means? It means that this kind of let me showcase here. This means this is not only formed in one, this is a single divergence because it has happened only once. Now if there was one more low like this here, and if I can find some more indicator which was showcasing, when if I extend this line, match that same same trend, right, showcase the same slope, then it has much higher chances of succeeding compared to a single divergence. So that is about RSI divergence. If you guys have any questions, please write to us at support@streak.tech. The same webinar, the same content will also be available in Hindi on our Streak channel. Streak YouTube channel, so do check that out. For any further help, please reach out to us and we'll be happy to help you out. Thank you guys. Have a great day. Bye bye.